What's going on, y'all? It's your boy Lando Success. So Jerome Powell just raised interest rates again. It's like the highest in like 40 years. We're going to talk about, for the average person that have no idea exactly how these hikes work, how does it actually affect you? You're going to learn all about that. I was reading an article that literally breaks everything down. So make sure you guys hit that subscribe button. Let's get right into it. So this is a CNBC article by Jessica Dickler. Shout out to Mrs. Dickler. Y'all funny. All right, here's what the Federal Reserve fourth 75 percentage point interest rate hike means for you. So we're going to skim over that because it's a lot to cover and I'm just going to read a lot of it. The Federal Reserve raised the target federal fund rate by 75 percentage points for the fourth straight time in a row on Wednesday, marking an unprecedented pace of rate hikes. So we haven't seen nothing like this in a while there. And this is my first time actually reading all the way through. The U.S. Central Banks has raised the benchmark short-term borrowing rate a total of 6 times this year, including 75 basis points increase in June, July, and September in effort to cool down inflation, which is still near 40-year highs and causing most consumers to increasingly cash strapped. A basis points is equal to 0.001% of a percentage. So when they say 75 basis points, that's basically how it's accumulated. A policy statement, we're going to skim through that part. Now, what does that actually mean for you? The federal rate, which is set by the central banks, is the interest rates that which banks borrow and lend to one another overnight. Although it's not the rate of the rate the consumers pays, the Fed move still affects the borrowing and saving rates they see every day. By raising rates, the Fed make it costlier to take out a loan, causing people to borrow and spend less, effectively pumping the brakes on the economy and slowing down the pace of price increases. Let's unpack that part right there. So basically, for those that don't understand, there we go. There I go. For those that don't understand, what happens is when Trump was basically making it rain, putting money out there. Everybody was making money. We was all happy. Businesses was getting paid. I was getting paid. Everybody's getting paid. Like Oprah just telling everybody to get paid, right? Now, what happens when you have things that's supposed to be right here, but money and people spending money and stuff is up here, they like, we need to calm some of this down because we're going to crash and we're about to crash fast. So what they do is the dumbest philosophy in the world. Okay, to calm down the economy, let's raise the price of everything. If you need a loan, let's quadruple, let's double it, because in our minds, that's going to calm people down from getting loans and spending money, and that's going to bring everything back down to even. Dumbest philosophy I ever heard of in my life, because while you're doing that, you're handicapping the economy even more. Oh, Lord, 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 help me, please. Help me, please. All right. Unfortunately, the economy will slow much faster than inflation. So we'll feel the pain well before we see any gains. Already mortgage rate has rocketed to 16-year highs. Home equity lines of credit are the highest in 14 years, and car loans rate are a 11-year high. So everything is literally as bad as you can think of it. We just don't feel everything the same. What I was telling somebody the other day, I'm like, inflation and we're in a recession. A recession don't feel the same like it did before because our access to making money has changed. Because back then, during a recession, you basically got laid off and you didn't have no means to make money. Now people have multiple options to make money, so that don't fully handicap you like it did before. We just see high gas prices and stuff like that. Like I went and bought some certain type of butter. It was like some gluten-free butter. My wife texted me. Let me show y'all. This butter was like $6.99. Earth Balance. $6.99 at the damn store today, yo. Like, come on, dog. Shouldn't be that high. That is inflation. Got my screen blurry after doing that, but we'll be all right. All right. How higher rates affect borrowers. This is, take your pen and paper off of this. This is great. Mortgage rates are already higher, even though 15 and 30-year mortgage rates are fixed and tied into treasury yields, and the economy, anyone shopping for a home has lost considerably purchasing power, in part because of inflation and the Fed rates policy moves. So they saying back in March rates was 4%. Right now they are 70%. That don't sound like the worst thing for somebody that don't understand exactly what's going on, but I love they give you an example, a visual. On a $300,000 loan, the house I just bought was $300,000, damn near even. So let's say Orlando, $300,000 loan, fixed rate mortgage in December was 3.11%. Think of that. So that monthly payment would have been about $1,200 a month for me to basically live in this house. So let's say I did that in December. Today's rate is 7%. That exact same $300,000 loan, exact same house you are in, your payments change to $12 to $2,000. That's an extra $729 a month just from buying that house now versus last December. Think of that. So if you add that, that is an extra $8,000 more a year and equivalent to or equal to $262,000 more over a lifetime of the loan, according to LendingTree. So you taking the loan out for $300,000, you paying $260,000 extra just because of that 3%. That's why most 3%. That's why most people are terrified to buy homes right now. That's crazy. The increase in mortgage rates since the start of 22 has the same impact on affordability as a 35% increase in home prices, according to McBride analysis. If you had been approved for a $300,000 loan in the beginning of the year, that's equivalent less than $200,000. So that's basically what I just said. Next, you have credit cards. Credit card rates are rising. Since most credit cards have a variable rate, there's a direct connection with the Fed benchmark. As the federal fund raises rates, the prime rate does well, and your credit card rate follows suit within 1 or 2 billing cycles. That means anyone who carries a balance on their credit cards will soon have to shell out even more just to cover the interest. So, let's talk to my younger followers who never had a credit card or never understood it. When I got my first credit card, I was like 24 or 27 because I never fully needed a credit card, right? But I didn't know how credit fully worked since I never had it, never was educated. So if my card said you got $3,000, Lando, here go your limit. I will spend $500 and my limit would be $2,500. And they say, okay, make sure you pay $35.99 a month. In my mind, shit, I can afford that. Let me just keep on paying it. What happens is, since you're carrying a balance and you're not paying it all the way off, that percentage they say is 29% is going to that carried on balance. So now you are not just paying back that $500. You can possibly end up paying back $1,200, which is crazy and nobody tell you about. It's more stuff into it, but most people haven't been educated about that. Let me know in the comments, when was your first time being educated about credit card debt and stuff? Let's see. Where was I at? Okay. Because the rate hike, consumers with credit card debt will spend an additional $5.1 billion on interest. $5.1 billion on interest. Jeez. Already credit card rates are nearly 19%. What did I say? 29%. Up from 16% in March. That's the highest since the Fed began tracking in 1994. So having credit card debt right now is the wrong answer. Auto loans are even more expensive, even though auto loans are fixed. Payments are getting bigger because prices for all cars rising, along with interest rates on new loans. So if you're planning to buy a car, you'll pay more in the months ahead. The average interest rate for a 5-year new car loan is currently 5.6%, up from 3.86% at the beginning of the year. So same thing, if we did that exact same thing, paying an annual percentage rate of 6% instead of 5%, 1% different, will cost a consumer $1,300 more interest over the course of a $40,000 loan. Lord. This is bad. Student loans vary by type. Student loans, yeah, you have to read and understand how that works, but they have an example for you. How higher rates can affect savers. Now you probably got some good news. The silver lining is that interest rates on savings accounts are finally higher after several consecutive rate hikes, because since they're raising rates, now you're getting more money in your savings account, which is terrible anyway. While the Fed has no direct influence on deposit rates, they tend to be a correlation to the changes in the target fund rates and savings account rates on some of the largest retailer banks, which have been near rock bottom low since C19. Excuse me. Let's see. Some are currently up to 0.21% on average. Not even 1%. Think of this. Coinbase just said they're going to give you 1.5% on your USDC. Robinhood is giving you 3%, I believe. That's completely pointless. So overall, I hope you guys learned something. I don't want this video to be too long, but I wanted to educate some people on what's going on. That is a great article. Shout out to Jessica for writing that. Let me know in the comments, what's your thoughts? What is your game plan? Because I think we are the F word. I think shit, it's bad. It's bad. The future don't look bright right now. But the good thing is that there's opportunity. Best opportunity. If you're new to investing, couldn't get in at a better time, to be honest, because you're going to learn a lot about the market. You're going to learn about what you need to do, what you don't need to do. So if we ain't rich yet, we don't need everything to be all the way up here. We need things to be down and keep on going down. So keep dollar cost averaging in, do your research on stocks and stuff. I'm not a financial advisor. I'm just a black brother giving you guys some game. Hit that subscribe button. I'm Lando Sess, and I'm out.